We turn our focus now to companies that are likely to disappoint during this reporting season. Jeff Middleswart is president and director of research at Behind the Numbers, an independent research firm that advises dozens of hedge funds and institutional investors on companies to sell and or short. He joins us now from Dallas with a preview. And very quickly, Jeff, I just want to pull up a chart we put together this morning. You were last on at the beginning of April 5th, 2011. And we took a look at some of the stocks that you had suggested shorting then. Turned out that, you were right. Corrections Corp, Geo Group, both of those on a total return level in the last 3 months are down. You can see R.R. Donnelley up 3.8% during that period of time. Let me ask you this. Are you still bearish on R.R. Donnelley?
Yeah, to me, R.R. Donnelley doesn't get any better for a short sale. It's the fastball right down the middle. Basically, it's a company whose main business is going away as people read on Kindle or they read on the internet and they don't print stuff. All forms, junk mail, 10Ks, textbooks are all going online. They're not going to be printed, and they're in the printing business. And on top of that, they're borrowing money.
Jeff, I want to make sure we get through all the stocks you're going to cover today. Vitamin Shoppe, right, switching industries entirely. This is a business I would think would be doing well, and certainly the stock up, 35% on a year-to-date basis. Total return basis, one-year total return up about 81%. Why are you bearish on this one?
Basically, every year they do an annual coupon to their big customers, and this thing has a 90-day expiration date on it. Normally, it runs like February and March and into the second quarter, so they see a benefit in same-store sales in first quarter and second quarter. This year, they rolled it out completely, literally like January 3rd. So all of the benefit accrued in the first quarter, not in the second. They had been seeing a declining rate of growth in same-store sales for several quarters in a row. They got a one-time pop out of the first quarter as a result of these coupons. And second quarter, you're going to have you have a very tough comp because last year you had coupons, this year you don't. And on
Jeff,
top of that, they did not raise guidance.
I want to cover Under Armour. This is a stock that has done very, very well. Year to date, up about 43%. But like many retailers, perhaps hurt by rising commodity costs?
That's part of the story. What we love about Under Armour is that they already missed last quarter on gross margin, and guidance is that gross margin will recover this year, throughout the year. And the big problem is that inventory grew at almost twice the rate of sales, which doesn't really, it is not conducive to holding gross margin. And they already pumped gross margin last quarter by cutting inventory reserves. So when you take that gimmick away and you have the higher inventory number you have to sell down, you're probably going to see more margin pressure. And then obviously everyone's aware of cotton and petroleum prices being up, which hurts them as well.
Jeff, we're going to have to leave it there. Unfortunately, we got Under Armour, Vitamin Shoppe, two of your bearish plays right now. We didn't get to First Solar. We're going to have to cover that the next time you're on. Thanks so much, Jeff, for joining us. It was Jeff Middleswart, president and director of research at Behind the Numbers.